asking a question, you can do so by pressing *6 and unmute by pressing *6 again. Pour mettre votre ligne en mode discrétion, appuyez sur étoile 6. Pour l'enlever, faites étoile 6 encore une fois. First question will go to Mark Rendell, followed by Julie Gordon, then Shelley Hagan. Go ahead, Mark.
Hi, Governor Schembri. Can you hear me? Hello?
Sorry. Yes, I can, Mark. Thank you.
Hey, great. Thank you for taking my question. Mark Rendell with the Globe and Mail. I'm wondering if going into the rate decision yesterday, there was much discussion about the quantitative easing tapering timeline and whether better than expected economic data has changed the discussion about when you may consider slowing the pace of government bond buying.
The quantitative easing program, as well as the forward guidance, are two extraordinary measures that we put in place to provide the necessary monetary stimulus we feel is necessary to support the recovery and achieve our inflation objective. The inflation objective is really 2% on a sustainable basis, and as we noted in the press release, that's going to be achieved when excess capacity in our economy is absorbed. And so the two things go together. And so when we discussed the degree of monetary stimulus, the two things, both the forward guidance as well as the quantitative easing, were discussed. And we felt that at this juncture, the same amount of easing was necessary. The commitment that we made yesterday was essentially what we felt was necessary, given the outlook we had in place at the time. Now, in April, we will be updating our outlook, and at that time, we will be looking at the persistent effects of the stronger momentum we've seen both in the global and Canadian economies on our outlook for demand. At the same time, we'll also be updating our outlook for the supply side of the economy. We'll be looking at reassessing potential growth in the global and the Canadian economies. So we'll be within the context of the projection, we'll be looking at both demand and supply. And in that time, we'll make an assessment as to how much monetary stimulus the Canadian economy needs to achieve the inflation objective. With respect to the quantitative easing program, we said two things. One is that the program will remain in place until the recovery is well underway, and our view is that the recovery is not well underway until we've basically seen ourselves through much of the pandemic. So that's still a ways to go. And the other aspect is really the pace of the purchases, what we said in the press release and last time, and again reiterated yesterday, was that as we gain confidence or continue to gain confidence in the recovery, the pace of the purchase will be adjusted as necessary. And again, that's a function of the degree of monetary stimulus we feel is necessary to achieve the inflation objective.
Got it. And quick follow-up there. You spoke about potential upside risk from consumer spending coming in hotter than expected. How does that, I guess, change the outlook for stimulus if more spending does get unleashed than perhaps you were expecting earlier later on this year?
Well, I think the impact, if that risk were to be realized, that's a risk we identified in January. If that risk were to be realized, then in terms of the one that I specified, where it was $25 billion that spread over the 3 years of our projection horizon, that essentially would bring the recovery forward somewhat. I mean, $25 billion over 3 years is not a lot of additional spending, but it does have the impact of bringing the recovery sooner. So essentially, again, conditional on the outlook for potential output growth. If that were unchanged, the output gap would close sooner than we had in January if that risk were to be realized.
Thanks, Mark. Julie?
Hi there, Julie Gordon from Reuters. Thanks for taking our questions.
You're welcome.
Interesting speech today. You didn't really speak about the money that will be spent outside Canada, foreign vacations, hotels, et cetera. Have you looked at how much money, how much of that additional savings will bleed out of Canada, and perhaps how Canada can try to keep some of that in country?
That was built into our estimates, Julie, in the sense that we looked at the savings, and we look, who accumulated the savings, and the marginal propensity to spend out of those savings in terms of various goods and services. And there was a recognition that there'd be a leakage into foreign demand. So the $25 billion that I put on the table is kind of a reasonable kind of estimate based on those marginal propensities to consume out of different types of goods and services, and based on who's holding the savings across different income groups. So we corroborated those estimates. One we did by type of goods and services, taking into account that some of the services would be spent overseas, and indeed some of the goods would be imported. So that's all built in, as well as the fact, and then we corroborated by looking at spending by income group. And so the $25 billion estimate was kind of a rough, ballpark given the savings. The important thing to keep in mind is this is a very unusual situation in terms of how the savings were accumulated. We haven't seen, in the fourth quarter, households were still saving at 12.5% relative to a historic norm of 4%. So there's still a lot of savings going on. So, it is an upside risk, and it may not be realized. But I think, it was an issue that people had talked about, and so we felt it was worth putting on the table.
Thank you. And to follow up, the pandemic has fundamentally changed the game on a national daycare program. It's been 50 years in the making, but there seems to be some real momentum behind it this time. What would a national child care system accessible to all mean for growth in the coming years, and in particular employment gains?
Well, it's a very complex question, because on the one hand, you have the additional fiscal spending, which that would definitely entail. And so the question is, how are you going to cope with the additional fiscal? How are you going to finance that going forward? And so that's an issue in itself. And then the other issues is really the question on the supply side. Will there be higher participation rates by women as a result of the daycare program? And it's really, how those two things play out is important. I mean, we've seen in Quebec that there is a fairly generous daycare system, and the participation rate of women in the economy in Quebec is relatively high. So that gives us some indication that effect might occur. But then there's the issue of how is this going to be financed? And if it entails higher taxes down the road, that has an offsetting impact.
Thanks, Julie. Shelley?
Hi, Deputy Governor Schembri. This is Shelley Hagan with Bloomberg News. In your deliberations, the bank has expressed concern on the uneven recovery in the labor market. So I'm curious what the bank considers to be full employment. What exact unemployment rate do you think represents full employment?
We don't really rely on one indicator, Julie. I mean, I think there's the unemployment rate, obviously, but there's a number of other indicators that are, give some indication of the state of the labor market, whether it be the employment rate, the participation rate. So there's a number of different indicators. We don't rely on one, but essentially, the employment gap does feed into our general consideration of the output gap. I mean, we rely fairly heavily on our measure of the output gap, and the employment gap or the labor gap feeds into that. So we don't really tie it down to one specific measure per se. And so, and the uneven nature really is an issue of the fact that it's really been affecting the most vulnerable workers in our society, youth, women. Generally, they're low-wage workers. So that's the concern about the low-wage, the uneven impact. It's an unusual recession in that regard. Typically, when we have a recession, often it's manufacturing that slows down, and we see the unemployment there. But this has really been a downturn that's really hit hardest the service sector, and it's really affected the most vulnerable workers that don't have a lot of financial assets, so can't really weather weather the storm. Often they're not, working part-time, and so they don't have the benefits. So that's a concern that these people have been hardest hit, and they're really the most vulnerable. So that's something we're taking into account. That it's important that the recovery be relatively complete, so that these folks are back into the labor force and working.
So to follow up on that, how much of an improvement in a recovery in low-wage workers in the low-wage sector would you need to see when thinking about removing stimulus?
Well, again, it's within the context. We would factor that in within the context of our estimation of the output gap. I mean, we're also taking into other labor market indicators, for example, participation rates by different groups. But it's really we look at a number of different indicators as well as the output gap. I mean, it's not one thing we're focusing on.
Thanks, Shelley. The next question will go to Kim Mackreel, followed by Greg Quinn, followed by Jordan Press. Go ahead, Kim.
Hi there. You talked about monitoring for speculative activity in housing markets, and I'm wondering, does that mean that you don't currently see housing activity as speculative? And if you determine it is becoming speculative, what courses of action, if any, might be available?
Well, we've taken note of the fact that house prices have increased relatively rapidly in recent months. And one has to recognize that what happened in 2020 in the housing market was very unusual, in the sense that there was a period where the housing market was effectively shut down when the restrictions were quite stringent and widespread. And then there was a reopening of the housing market, and so there was a release of pent-up demand. At the same time, you've had a shift in demand, an increase in more residential space as people have been working at home and have concerns about contracting the virus. And so you've got this shift in preferences towards more space. And at the same time, people are not listing their houses because they're concerned about, moving, about having people walk through their house. So there's this strain, there's these combination of unusual factors that are affecting the housing market, and all those factors are tending to push up prices. And so these fundamental factors are underlying the price increase. But we've seen in the past, not only in Canada but in other jurisdictions, that you have these fundamental forces that are initially causing house prices to increase, and then they sort of take a little bit of a life of their own. And so, our concern is that that if these price increases were to to continue at the same rate, and we saw more evidence of speculative activity. I mean, the governor, said that there's when he was asked about this question, said there's emerging signs of excessive exuberance. I think these signs are continuing. I mean, he spoke about a month ago, and we've since then seen price increases that are slightly higher than were taking place at the time. So it is a concern. I mean, and it's something we're monitoring closely. In the past, we've identified financial vulnerabilities associated with the housing market in a financial system review. One was housing market imbalances related to house price growth, and the other was household mortgage debt or overall household debt. And as part of that, monitoring those vulnerabilities, we're going to assess what's going on in the housing market and their potential implications for those vulnerabilities, and that will be reported. We have a financial system review in May, and then we have the financial system hub. So there are opportunities for us to do the analysis, to look at these house price increases and the implications for financial vulnerabilities, and provide the analysis there. So the critical thing is we're going to be monitoring them, and that's our major contribution at this point to really to these house price increases, being vigilant and analyzing them closely to see if there is a significant pickup in speculative activity and there is extrapolative price growth.
Thanks. I'd also like to ask about the role of immigration in the recovery. It was down sharply last year. The government has said it plans to ramp up immigration levels quite a bit this year and over the next couple of years to make up for some of what was lost. Can you just describe what you think the impacts of the slowdown in immigration last year might be for the economy and how plans for more immigration might impact the recovery and growth?
Well, we did look at the immigration levels in our assessment of potential output growth in Canada in October of last year. And so we did take down potential output growth somewhat based on the immigration levels at the time. We're now we'll reassess potential output growth in April, and we'll be looking at the immigration numbers as part of that reassessment. I know the government, we've seen what happened in 2020, and we know what the government is sort of intending to do going forward, and so we'll look at those plans and incorporate them into our estimation, our estimates of potential output growth. I mean, clearly, the immigration levels that we've seen in past years have been an important source of growth. They are contributing to potential output. They are contributing to demand. So they have been important in the past, and they're likely to continue. I mean, it's an open question about how quickly the government can get immigration levels back up, given the travel restrictions that are in place. So it's definitely been important in the past, and it will likely be important in the future. But the timing is really uncertain because it really depends on the evolution of the virus.
Thanks, Kim. Greg?
Hello. I wanted to ask a bit about inflation. Inflation doesn't really get to around 3% that often as you're projecting now, and this is clearly a unique kind of economic rebound. Well, what makes you confident there won't be a second round effect on prices that keeps it above target?
We did anticipate that in January that there would be an increase in inflation, largely due to base year effects. I mean, at this time last year, gasoline prices were, somewhere in the neighborhood of 80 cents. They're now per liter. Now they're $1.40. So there's been a big increase in gasoline prices. Although gasoline is only roughly 3% of the CPI, it does, that degree of volatility has a big impact, and it does flow into other things as well as transportation. So it does have this impact. And so in January, we were anticipating this base year effect washing out, and therefore having inflation jumping up. But since January, as you know, we've seen oil prices increase from roughly $50 a barrel to $65 a barrel now for WTI. And as I mentioned, that's contributed to the higher gasoline prices I just quoted. And so that's a shock to our monitoring for inflation that we had in January, and so that wasn't fully anticipated. So that's why our monitoring is such that inflation could rise close to around the top of our control range over the next few months. In terms of a second wave, our expectation is that if oil prices remain at the same level, what will happen over the course of the year is that the base year effects will dissipate. Plus, we have this ongoing drag from excess capacity, which tends to exert downward pressure on inflation. So, once we have this, rise, we expect that to be the inflation rate to moderate over the course of the year because of these other factors, the base year effects dissipating, and then there's ongoing drag from excess capacity in the economy.
Thank you. I was wondering also about the talk of slack in the job market. You're keeping policy stimulative in part because of what's going on in the job market. But isn't there a point where some of the things going on in the job market are beyond monetary policy, such as, long-term unemployment and, this idea that certain segments of society, low-wage workers and others, are having a more difficult time than other people in the job market?
Well, one has to acknowledge the fact that the number of unemployed now, we've lost 850,000 jobs relative to February of last year. That's double what we experienced in the Great Recession. So it's an immense increase in unemployment. And so it's going to take time for those people to get back into the labor force. So the recovery is going to progress relatively slowly. The point you mentioned about restructuring, yes, there's going to be restructuring, and workers are going to have to be retrained, switch industries. That's going to take time. But monetary policy, part of that is to support that kind of restructuring. We want to facilitate that so there's demand so that people can actually get back into the workforce. I mean, there's always going to be mismatching. There's going to be jobs open that people don't have the right skills for, but that's always the case. But I think in this case, given the unusual nature of the shock, where we anticipate there's going to be some degree of restructuring, monetary policy should be supportive of the restructuring and allowing new firms to start up, as well as workers to get retraining and find their way back into working.
Thanks, Greg. We're coming up on time, so Jordan Press, last question will go to you.
Good afternoon. I guess my question is kind of a little simple here, which is that in your speech you talked about household spending. And so is the message that people should take away from this, from the average person, should be, hey, just spend the money, please. We don't really care on what, just spend it so that we can maybe get a recovery faster. Or is it, please spend it, but spend it on specific things so we can help the sectors hit hardest?
Well, we're not being, the purpose of my speech was not really to be prescriptive. I'm not really telling Canadians to do anything in particular, but I'm just saying if this were to happen, if Canadians were to dip into their savings and spend more over the course of 2021 and 2022, then this would be the impact on our economy. That's my role as a central banker, to analyze what could happen. I'm not here to proselytize about how people should manage their finances. That's something that I trust Canadians to do themselves.
And as a quick follow-up, just to go back to what Julie asked about daycare, I'm just wondering how you account for something like that when you start thinking about the outlook going forward, when you have steps towards a national daycare program, for instance, and seeing the Quebec experience. How does that start to factor into the outlook you have for the economy, and how you then start planning monetary policy, knowing that national daycare is on the way?
Well, there are a number of different effects that, I tried to highlight too in my earlier response. Clearly, more generous daycare would likely lead to a greater participation of women in the workforce. I think we've seen some of that evidence in Quebec, but there's this argument that daycare this generous daycare pays for itself, and it's not clear that's actually true. And so there is a cost. There's a fiscal cost associated with more generous national daycare program. And the question is, how is that cost financed? And if it's through higher taxes, that's something that has to be taken into account. Clearly, if there's larger female participation, they're going to be spending, and so that's going to have a beneficial effect. So there's a number of factors that we'd have to take into account in terms of the economic impact of such a program.
That concludes today's press conference. Thanks to you, Deputy Governor, and thank you all for joining us. Great.
you.